It wasn't a great year.
And I want to challenge you on that point.
Investments are down, exits are down, because I haven't started challenging yet.
There is a story to every number. So there's a disconnect between what the media might say versus the actual availability of capital. The headline figure for venture capital investment across all of those regions is down something like 40%. We have literally seen 2 years of almost 50% decline in venture capital investment. So while the headline figure may be down this year, the underlying ecosystem is up relative to last year, which is extremely healthy. So if you remove the anomalies of the 21 and 22, venture investment is still higher to a certain extent than what we saw in 2019 and 20, which were record years compared to the last 10 years gone by.
Interesting. So, hi everyone, and welcome to Conversations with Lulu. I am Lulu, an entrepreneur, a venture capital investor, a mother, and your host. My guest today is Philip Bahoshy. It's his 4th time here on the podcast. It's our annual tradition. He is the founder and CEO of MAGNiTT, the platform that tracks the data shaping the emerging venture markets startup ecosystem. If you've ever wondered who's raising, who's failing, who's bluffing, then Philip's your guy. This is our annual tradition where we cut through the noise and ask what the hell is going on in the MENA startup ecosystem. 2024 was an interesting year. M&A and exits were down. Funding was down, but we ask why. We try to understand the story behind the headline and not focus just on the headline. Fintech is still the clear winner. The air is getting thinner as companies mature. International VCs are flirting a comeback to the region. AI is getting all the money, but who's really benefiting? And the UAE and Saudi continue to court founders. Before we kick off, if you're enjoying these raw, no BS conversations, make sure to hit that subscribe button. And Happy New Year.
Firstly, I'd like to thank you for inviting me, and secondly, applaud you.
For the 4th time.
For the 4th time, but applaud you because it's been the 4th time and the success that you've done. You're still here and you're doing amazing. No, honestly. But to that point, you are able to do something which I've done it fortunately in my own way. I've spoken to a bunch of founders and done public speaking for different events. But you really learn the backstory. And the more you research that person, every success had a journey and struggles. And what I love, especially in the last couple of years, is that you really kind of dig down into that. And it's not about the success and it's the Amazon story and the Uber story and etc. It's really the journey that got them there and the health issues, the mental health issues, the difficulties that they've been through to get to the point of success. And I really applaud you for that because anyone you're speaking to, whether it be investor or founder, there is always a journey to get to the point at what they're at.
So the lesson is what? Don't be intimidated by people.
Well, it's just to respect that everyone has their journey.
Yeah.
I always talk about a lesson that I learned in INSEAD during the MBA. One of the classes that we did was Negotiations 101. And the basics for negotiations, whether it's a commercial contract, whether it's politics, whether it's any conversation that you're having. The lesson that I learned was always put yourself in the shoes of the person that you're negotiating with and try and understand where they're coming from before you start the negotiation or the conversation. And why is that powerful? Because normally when it's a commercial contract, politics, anything, you're coming with your view and you believe that's right. And when you put yourself in their shoes, it's not just the commercial or political or it's also the emotional. It's the personal journey. What is it that triggers them? Why are they being like they are? Did they have a bad day? Were they frustrated with something personal? Like if you don't take a second to try and think about why that person is the way that he is, then when you go into the conversation, you're going to be very stubborn about this is your perspective. Yeah. So even with the team, sometimes people get upset with things that happen at work. And I kind of try and take a step back and like, have you considered the pressures that person was under? Did you apply an element of empathy as to why they could be frustrated? Did something happen in their personal life that you didn't consider?
Yeah.
And so when you talk about founders and VCs, sometimes people don't ask the basic questions. Do they have money to deploy? You're frustrated that they don't want to come and give you investment, but have you done your research? Is your company the right type of company that they would be interested in? Have you understood that they're fundraising? Like, some of those type of questions, because there's a lot of frustration around they didn't want to invest, they rejected me, and etc. Now, I'm not saying that all VCs are necessarily right in the way that they communicate, and I think that there needs to be empathy on both parts. If you want to criticize, sometimes the venture side is, do they say no quick enough? Something Silicon Valley theory that you listen to is, you go quick to saying no because you don't want to string people along.
And they're quick to say yes as well.
Quick to say no and yes, but even no. Just say no. But to the point on the other side is, do the founder actually understand what's going on? Are they busy? Did you follow up? They didn't get back to my email. Did you follow up? Did you follow up twice? Did you take the time to ping them or something like that? So there's always two sides to any story. And that's the kind of learning lesson that I got from them.
And there's a time for the ask as well. Like sometimes, you're at these conferences, and you meet investors, and maybe let's say there's a party at the at the end of the conference or something like that. And people are just chilling and having a good time. They've had a long day. They've been pitching and answering and so on all day. And then there you come with your pitch, right? Like I feel also there's a time for things.
We have this with work as well, and I've been trying to advocate this for our salespeople. You can't sell at a conference. You can't sell at a drink. You can't.
Have a drink, exactly.
The
Enjoy
goal
it.
should not be that. It is to create a human connection. Ultimately, have you brokered a human connection that allows you to have a follow-up meeting? If your KPI is to go and pitch at an event, then it's somewhat flawed. Can you build a connection? Can you find out if Danny from Biko likes football? Can you go and sit with Basil and discuss the political situation in Egypt? Can you go and sit with someone and talk about their summer plans so that you build a relationship and say, oh, look, it was a real pleasure. I didn't want to bother you today, but you know what? If you're free in a couple of weeks, I'd love to connect. But if you just go in and say, I run this company and this is what we do and we're looking to fundraise, and it happens to everyone, right? And I mean, even I'm not much, but like people, whenever I speak, come and say, this is my startup. And I'm like, guys, I'm not an investor. So like, sorry, but with all due respect, you're wasting your time. Okay, but can you come and give me advice? And I'm like, well, I'm not an advisor as well. Like this is, there's different people for different things. Come and build a human connection. And I like the person, and maybe there's something that I like about the product and I can help with.
Maybe
that's very different. Way of building that relationship. But the transactional method of at these events, just immediately going up to people, I've been advocating for much more roundtable curated events where why? Because people feel more comfortable engaging and learning. I went to an excellent event in Saudi, the 24 Fintech one, where there was matchmaking effectively for different protagonists, and it was an invite only. And again, of course, you have to be in that position to be invited and etc. But they basically connected different people based on interests together. I was able to meet 5 to 7 people I had never met before, whether they were government, corporate, investors, and left that event coming and telling you about it because it was particularly curated, useful, but they also almost force you to sit at a table, you have 15 minutes, go to another table, 15 minutes. And you left that going, I made a connection that I wasn't able to make necessarily otherwise because you're just standing around and having drinks. And so those are somewhat more powerful than tens of thousands of people running around and jumping and speaking to each other, which is why some people don't enjoy going to events unless it's their job and they have to. But because you're just going to get inundated. Why is it? I mean, like, has anyone ever broken down why everyone sits in the investor lounge all the time? Many founders get very frustrated because they're all like, oh, we can't get access, we can't get in there, and etc. Human nature dictates that people get comfortable sitting with the people that they're familiar with and they can chit chat and etc. But at its core, the second they go out, they're attacked by all of these different types of people. So for them, it's
try walking with Fadi Randour, for example, at an event.
Absolutely. And Fadi's amazing.
It's just not, he talks to everybody.
And he talks to everyone and he has a smile doing it.
I know. I don't know how he does it, by the way.
But I mean, even he will get to a certain point where it's just like, okay, guys, like, please.
So what do founders do? I mean, that's like
That's a great question.
Because you know, so we have been around for a while, right? So around the same time, probably you and I. So we know a lot of people, right? So we don't have this issue. But for those new founders, what, like, you would usually go to these events to meet people. So maybe focus on building a connection, as you said,
Yes.
versus closing the pitch, like pitching
Definitely, 100%. It's not about going and pitching at any of these events. If you're going to go to a talk, so I used to do that. You go to a talk. I still remember STEP back in the day. You would go and see, I always loved those original conversations where they had the founders and the investors.
Yeah. I remember that debate.
With Danny.
I was part of one of them.
Exactly. And I learned a lot from that. Danny was, and I learned this.
So this is Danny Farha.
Danny Farha from Biko was talking about, it was founders complaining about how difficult it is to raise funds.
Yeah.
And they were saying that there aren't enough VCs in the region and there aren't enough funding in the region and the standard and the challenges that founders face.
Yeah.
And then Danny, and this must have been 2015 or 16, so one of the first STEP conferences that I attended, and it was a great panel. And then Danny was talking about, guys, you do realize that we have to raise funds. This is not a charity. We do not just have money in the bank. We also have to go and get money from investors.
Yeah.
We also have a mandate, which is usually 6-7 years, and I'm paraphrasing here, this is not his words, but the sentiment of what he said, where we have to provide them a return.
Yeah.
Right? So if you think it's difficult, it's also difficult from our perspective. So when we're saying no, and we can only make 20, 25 investments, we have a mandate and we have a requirement to make a return for the investors who invested in us. And if we don't fulfill that success, they might not invest in us again. And the reason I bring that up is because it was the first time I'd always come from the founder and I always heard all these founders complaining. And I've been to many conferences and you can very quickly, if you surround yourself with founders, get kind of cocooned into the mentality that the VCs are wrong. We should be us and them.
Yeah.
But it was really insightful because for the first time I realized, wait, so it's that put yourself in the shoes of the person that you're negotiating with. It was the first time I had received an insight from someone that you would be having a conversation with, which is why I found it particularly interesting. But to the point that I was saying, if I was at that event, I would send a LinkedIn message or find a way to get connected to Danny to say that point was super insightful.
Yeah.
I never realized that. And I thought that it would be great to learn a little bit more. I'm not sure if you're available or if an associate would be available, but thank you very much for sharing that. Would you be free for coffee, etc. So can you build a relationship with someone? And it could be an insight, it could be an AI discussion, it could be a fintech discussion, it could be a regulator. But my point is, if you immediately go to him as he walks off stage saying, "Hi, Danny, nice to meet you. I have a fintech startup that is looking to disrupt payment gateways and etc." He's literally just stood on stage and poured his heart out and explained something. And then you're coming off stage and you jump him versus just going and saying, "Very nice to meet you. Thank you very much. I thought what you said was super insightful. I'd love to connect in the future, but I won't bother you now." He'll remember that.
Yeah.
I mean, he might remember that. But it's that soft approach, which is extremely different to just...
I did an episode over the summer, by the way, so I did like a 3-part short episodes where I basically spoke to camera about, things I thought about with regards to entrepreneurship and startups. And one of the things that I said is like what makes a successful entrepreneur is that you need to be memorable, right?
Yes.
Like that first impression that you make, right? Did you make the person feel, "Oh my God," or did you make the person feel, "Oh wow, I really like this person"?
Well, it's with anything. First impressions count. You have to have something that makes impact and storytelling. Because the next step is when you are in the conversation with that person, can they capture your imagination because they're meeting so many different people?
Yeah. So being memorable, right? Like,
absolutely.
Like how that minute or 30 seconds or 5 minutes that you spent with the person, how will they remember you? I think that's so important.
And you don't get many. So you get one. To get the second, that needs to be memorable.
The second meet. Exactly.
Anything, just a second interaction.
Exactly.
And so...
if you're not memorable, forget it. It's not going to happen.
Exactly. But that's difficult. That's
or you see them at another event and you go pitch them again.
But Lulu, this is why they say, and Fadi's the one that said it back in 2015 on stage when I interviewed him, serial entrepreneurs make the best entrepreneurs. Why? Because they've had to learn all of these experiences firsthand.
Yeah.
I mean, one of the things that I think is going to be the next evolution of the MENA kind of venture space is that we will see the re-emergence of the serial entrepreneurs, the people that went through their experiences in the last 5 to 6 years, similar to yourself. You're applying everything that you've learned in Nabish, and you're doing it through the podcast in a very different kind of mechanism. There are many others. You look at Hussam, you look at many of the Kareem guys are, these are the top echelons, but they're reinventing themselves with Kareem each time.
Yeah.
It doesn't mean that they're building a new startup. They're building new companies within the companies that they've already built. But to the point that you're making, they've learned the lessons the hard way, as any of us would be doing as we're building out these companies. And so the normal question is, what would you do differently if you could do everything again? Well, that's the opportunity. If you start again, what is it that you would do that would be impactful? And sometimes the serial entrepreneur doesn't need to start a new company. I mean, if you look at Ambereen, she started the second version with Yabi, and then now she's gone on to...
Ambereen Musa is the founder of Souk Al
Mal that did Yabi, and then now is leading Revolut for the region. I mean, it doesn't need to be the serial entrepreneur specifically building a company from scratch. You can go on and take other companies, but all the wealth of experience that she would have learned with the company that she's built, she's now applying to a new venture or a new opportunity. And that is part of the exercise.
Yeah.
And you wouldn't cold pitch someone and et cetera. So there is an element of, for the founders, you got to learn the hard way. I mean, we can sit here and say, this is what you should do.
Yeah.
They'll probably ignore it. They'll go and try 5 times. And then maybe the 6th time, they're like, actually, this isn't working. So you can give as much advice as you like. But in the end, the harsh reality is you have to do it yourself.
Yeah. On reinventing yourself, I've also had Dana Baki here on the podcast. I mean, she went from entrepreneur to she's now working in the space industry.
Absolutely. I heard that.
Talking about reinventing yourself.
You've had some great speakers.
I have. Again, that's why I do it, right? I mean, I'm not getting rich out of this, that's for sure. But I think well, let's hope so.
Joe Rogan did. So, I mean, like you have the goal.
Yeah, well, thank you for making that comparison. Hopefully we'll get there. But I just wanted to add one point to it, is that sometimes it takes months and even years.
Yes.
So like the people that you see here on the podcast and people that are come here, these are people that I've had relationships with for years. And that's why when I reach out to someone like Mudassir, I mean, he would come on the podcast because like I've known him for years. So I think this is also, people are very impatient. You want to meet somebody, you want to pitch them immediately, you want to get something out of them, transactional. You know, I got a message recently. I'm not going to say from who, but anyway, I got it on all my channels, on my podcast email, on LinkedIn, on WhatsApp. I don't know how they got my number, on Instagram. And basically saying, we really like, some of your guests on the podcast, and they have a podcast too. And they said, would you mind introducing us, to Ronaldo? And I'm thinking,
why?
Wow. I mean, what an ask, huh? Like imagine somebody messaging me who has a podcast and say, please introduce me to Ronaldo. I want to get them on my podcast.
Example of, did they put themselves in your shoes when receiving that email?
I mean, how do you answer that? See, I just didn't answer, but I just thought, really?
And so if you put yourself
like Ronaldo
in
is an easy person to reach, right? It's not like, I mean, you can find him on LinkedIn. He's like...
Yeah, but if you put themselves in your shoes, receiving that message, why? What's in it for you?
Yeah.
Why would you receive it on 4 different channels? How about, I'd love to catch up with you and learn on what you're doing. We're in a similar industry. It would be great. I received a DM from someone, which I'm not going to mention, but in my space, because I liked a tweet that they did. And I was shocked because it's a very prominent person globally. And it was a very simple message of, we're in a similar space. I really like what you're doing in the region. I have absolutely no agenda, but I'd love to jump on a call. And I'm like, whoop-de-doo, sure.
Yeah.
Absolutely.
Yeah.
And we've built up a relationship since then and stayed in touch. But it was off the back of, I've got no agenda, just really like what you're doing, similar space, love to bounce some ideas. Would you like to jump on a Zoom? But when you're going and say, can I have all of your contacts because I wanted, So
I like it. I think this is super valuable, right? Because I mean, it's important for people to know how to communicate with others when they want something.
It's difficult.
And it does take time, and yeah, it does take time. You recently put out the MAGNiTT 2024.
Yeah, we're back again.
Wrap up.
End of year.
So let's dive into this. It wasn't a great year, right?
Yes.
Investments are down, exits are down, deal numbers were down,
depending on where. Yes. So we publish now what we call the Emerging Venture Report. We cover Africa, the Middle East, Southeast Asia, Pakistan, and Turkey. Our stated ambition is to become like the leading platform for private capital across emerging markets, not necessarily covering the US or Europe, but the emerging venture space, because I think the data set and the insights are very different to trying to compare to the US and Europe. And I want to challenge you on that point, that it wasn't, I don't know what you said, it wasn't a good year
because I haven't started challenging yet.
No. And I just want to challenge that rhetoric.
All right.
Because this is something that we as a team are very dear to.
To say that it wasn't a good year?
Yeah. And because this is the clickbaitiness, which is something that I really, and I'm not challenging you for it because it's the right sentiment, it's what everyone says. There is a story to every number and there is a journey. It's 12 months of investment. So yes, the headline figure for venture capital investment across all of those regions is down something like 40%. And the total number of transactions are down. Now, that is a whole region.
So what's the number? How much was invested? Let's talk about MENA just for the sake of this.
9.1 billion across all emerging markets. It's about 1.9 billion in MENA that was invested in the last year, which is down relatively 25% from the top line figure.
Okay.
Why? Okay. So the question that I asked the team, so for our clients that are subscribing, we do a whole bunch of reports, whether it's the emerging market report, the MENA, we do a country one for Saudi, UAE, we do an investor ranking, we go into a valuation deep dive. And the question that I challenge them with every single time is, why? It's not the numbers. You can read the numbers.
So why?
I got this from an investor who criticized us and said, your reports say this number went up and this number went down. Like, what am I learning? So I told the team, great, that's the feedback. Now we have to explain why. So why are the numbers down? We'll take a 5-year view, right?
Okay.
So effectively a 5-year view was COVID, which somehow people have now forgotten about. So 2019, pre-COVID, I remember a time we've been in this ecosystem long enough and I've been doing these reports long enough. Every year was a record year of investment because capital was being deployed and everything was going right. COVID comes along, a challenging year for startups, but a year of two halves where venture investment stopped in the first half of the year. And then interest rates dropped to 0% pretty much globally because they want to re-stimulate the economy after we were all sitting at home for 1, 2, 4, 6 months, depending on where you are. And venture capital, as an asset class, people had to put money to work. And again, the crowding out effect, which is something I keep talking about. What is the crowding out effect? If interest rates are at 5 or 6%, and I think I mentioned this last year as part of the kind of logic, you can get cash and a return of 5 or 6% just by putting cash into a bank. That is a healthy return for not doing much. You can go and get corporate bonds at 7, 8% with relatively low risk compared to other asset classes. When interest rates are low and you have nothing to deploy into, you have to look at alternative classes. Stock markets have been at record highs for literally the last 2 to 3 years. I looked at the numbers this year. I think that the S&P was up 23%. The NASDAQ was up 26%. Last year, the NASDAQ was almost 35%. The S&P was close to 18%. These are all, talk about just pure banking terms, these are all returns that you can do without doing venture as an asset class. And everything means, what is the alternative to the investment that you're making? So your alternative to investing in startups is 5 to 6% in cash, 7% in corporate bonds. Potentially, if you just invest in an ETF, albeit that's not how you invest in the stock markets, you could invest and get 25% as a benchmark. So then you come to, you look at real estate.
And it's highly liquid and you can sell your stocks anytime. You
look at real estate, which is slightly long-term. Everyone's talking about how here in the UAE, Saudi Arabia, huge opportunities for growth in the real estate. And that's a whole industry in itself as a sector. Which means that when you look at venture capital, when those are the benchmarks, you need an annualized return on investment of close to 25 or 30% to justify investing in that asset class, as opposed to putting your money in the bank or just going into corporate bonds.
I would say probably more, actually, given the illiquidity of the...
But annualized, like every year of that illiquid period shows that as opposed to when interest rates were at 0%, for a period of COVID up until they started raising again in around 2021-22. Why did we have that boom? So I'm giving kind of the history of what happened in 2001, 2002, if not in the region in 2003. Everyone had to put money to work because you weren't getting that returns in cash. You were not getting that return on bonds. That whole fixed income part of the portfolio was not performing. Markets fluctuated. So naturally, people who had liquid assets or sovereign wealth funds or pension funds had to deploy into an asset class. Venture became extremely appealing, which is why in the years of 2021 and 22, you had records amount of venture capital investment globally and within the region.
And also, by the way, I think there's a caveat here, venture as part of a private equity.
Private capital portfolio.
Yeah, private capital, yeah.
So, I mean, if you take a typical portfolio, you'll have now what they recommend if you speak to a bank, something like 50 to 60% in equities. You might have 30%, and this is for a private individual, 30 to 40% in fixed income. 10 to 15 should be in alternative assets. And so again, take an amount, you're talking about 10 to 15 should be allocated. If you're sovereign, maybe you have a different type of allocation. And those are longer term investments, which include private equity, private debt, so credit, which are very attractive now given the situation that we're in, venture capital, real estate, and infrastructure, which are the pools of less liquid asset classes compared to the markets or fixed income. So they had to put money to work because the returns on the stock markets and the interest rates and bonds and the fixed income were not generating as healthy returns. So everyone was flooding into venture capital, private equity, different type of asset classes. Once interest rates start going up, and again, the global phenomena, that crowding out effect that we were speaking to became a lot more expensive, and the returns had not been seen in terms of the liquidity and the exits. First thing you started seeing in the US was the IPO window started to narrow. You saw less companies exiting on the public markets and M&A transactions. As a result of that, VC funds have to start going back and reporting that actually we're not seeing the same returns as we were seeing before.
But also, sorry, quick comment on that. You not only saw less companies exiting in the US, you also saw the massive gap between the private valuation and the public valuations, right? So when they did exit, when they did IPO, the IPO
returns. That's yes, and that's a separate area, which is the return of investments on the public listings. But number one was that less companies were listings because their internal rate of return when interest rates go up becomes a lot harder to achieve. And so that starts happening. So naturally, investors start pulling back. The other thing that I heard you speaking about with Sky on the last podcast, even on previous podcasts, is that the down round. Valuations were so high because people were giving out liquidity. And I love the conversation that Sky was talking about, is that you actually have to have honest conversations around valuations. Investors may be attracted by higher valuations, founders might be attracted by higher valuations. But if you can't raise another round in the next 12 to 18 months, at a higher valuation, you have the down round phenomena. And you talked about this with Abdullah from Taylor Wessing, where you were talking about the challenges of the down round and why so many people are doing bridge rounds to weather the storm, as opposed to accepting a lower valuation for investors that invested at much higher amounts. And it's complicated to get around all the concepts.
But I think it's all connected in a way, right? Like why were the valuations so high? I mean,
because there was so much excess liquidity that money was being put to work, and people could command much higher numbers, and the money was being put to work There was also the other thing that everyone wanted to be in all of these hot deals, and they didn't want FOMO kicked in, and deals were getting converted much quicker. And again, this is a global phenomenon. It wasn't a regional one necessarily. This is what was happening in the global. I mean, go to any of the podcasts that you were listening to on US investments in 2021 and 22. It was like a heyday of venture investment.
Yeah.
The problem is when the tap stops, then the consequences of all of that begin to kick in. Companies need to restructure. We've already seen massive layoffs in the tech industry, i.e. the big tech industries, compared to the time. So your Googles, your Apples, your IBMs. And even now, I was reading on the way here, big announcements of companies that are still having to cut costs to get back to unit economic focus, because that next investment round or that next amount of capital is not evident as shown by the data. Founders have to take longer to fundraise, and therefore need to make that money work for them a lot longer. Naturally, that leads to a higher failure rate of companies needing to potentially shut down because they can't sustain their businesses unless they were able to restructure. We go back to the whole conversation I said about Danny at Step. All of the funds may have deployed and therefore do not have capital and are themselves fundraising. Therefore, how much dry powder is actually available? And even in the concept of dry powder, what gets announced in the news versus what is actually in the bank to deploy are two different statements of fact. You can announce an amount, but it doesn't mean that you can capital call it and actually give that to different companies. So there's a disconnect between what the media might say versus the actual availability of capital. All of that to say, naturally, globally, we've seen a slowdown of venture for effectively 3 years. Now, we are all in the data business waiting to see the year-end reports of the global players to talk about what's happening in the US and Europe. I was looking at Carter. Again, Peter puts out data based on Carter's companies that US venture, which is what we anticipate, has plateaued, i.e. is effectively flat, if not increased, but very marginally. But the point he makes, which is basically what I'm saying, is the levels are still higher than the figures of 2020. So if you remove the anomalies of the 21 and 22, venture investment is still higher to a certain extent than what we saw in 2019 and 20, which were record years compared to the last 10 years gone by.
Interesting. So actually that sort of also align with, I'm sure you know, Eden from Clear World.
Love the work he does.
Yeah, me too, by the way. So I think he disagreed with you on the interest rate issue, that basically here in MENA, right, all the money for the VC funds is coming from the sovereign wealth funds regionally.
Great.
But he also said actually that quite a few funds were like that raised in that heyday period. They have deployed all the money that they had to invest. And that's why also you see that sort of like a correction in the amount of funds being invested. So what you're saying is, you know, COVID is an anomaly. It had like a ripple effect in terms of first like the confusion that it caused initially, but then as a result, the interest rates went down.
Well, the macroeconomic impact of that. And they have to re-stimulate an economy when it shut down. Yeah. They had to take action.
So if you remove that, if you adjust for that anomaly, you're saying that today we're still around the same level as pre-COVID.
Exactly. So effectively, you're, in terms of monetary amounts, in many of the geographies that you're covering, you're still at investment levels that are in line, if not higher, than what we saw. And my point is not that. My point was those were record years for the last 10 years gone by, if not more. Yeah. And so that trajectory of growth is, you take out the two, it's flattened to a certain extent, but it's consistent with growing venture. And my point of all of that is, back to the thing that you said, yes, it's down relative to but and even then I want to just kind of explain why it's down. So we track, as do all global players, mega deal investments and late stage investments versus early stage. So what's a mega deal? A mega deal is an investment amount that is categorized as $100 million plus of investment into a company. This is the area that has been the hardest hit out of any of the different segments in the last 2-3 years. Okay. And so, again, it's a bit of a maths kind of conundrum and you have to be a bit of a statistician. But like in its simplicity, the contribution 80-20 almost of any figure can come from those big deals. You have 5 or 6 or 10 big mega deals, your headline figure will grow. It doesn't matter if you have hundreds of 1 millions and 50 million, 5 million investment deals, which could be extremely healthy for an ecosystem. That top level number will only be impacted by the big investment deals. So let me give you a point in numbers. If you go back to 21 and 22, and we looked at this, mega deal investment contribution of total aggregate amount was close to 75% of the investment figure. If you go to this year's figure, it's around 25 to 30, depending on the geography that you're looking at. Which for me is still a positive. If you look at Saudi Arabia sees a year-on-year growth in non-mega deal investment activity compared to last year, where last year there were 4 big mega deal investments that accounted for close to 70% of the whole investment number.
This is Saudi.
As a point in case. So while the headline figure may be down this year, the underlying ecosystem is up relative to last year, which is extremely healthy. In fact, they've seen a 16% increase in the total number of transactions compared to last year. So the reason I'm saying that, and the UAE, similarly, it has an increase in the total number of transactions, and Egypt and Qatar. They've seen increased deal flow, but that number that gets put into a press release or that number that goes out to the press sees total capital go down. And then you beg the question, why? We are not seeing late stage investments. Why? Because if you can't see where the capital is going to come from the next investment round, if the cost of capital is extremely high, it is a lot harder to do. And if the capital availability isn't there, and historically, late stage investment in our region, we go back to the heyday of 21 and 22, it used to be international players.
So late stage is someone writing what? A $20 million.
Even bigger. 20 million is not even, I mean, that's still your average Series B. Sure, that's later stage than Series A. You're talking about 50, 100, $150 million plus investments into big late stage companies. There was a time we were seeing funding announcements of Kitopi, you see big investments at Kerim, you saw all of those, like these were regular occurrences. That's dried up relative to years gone by. And it's because it's harder to get access to that. It's harder for investors to justify it without seeing where the next investment round is going to come from. We can come on to IPOs and exits, which is the third successive year of M&A decline and IPOs still being a challenge for the region versus making an investment. And this is the headline from the numbers that we saw. Close to 50% of all investments this year in MENA came from investment between 1 to 5 million. Which shows that there is somewhat of a shift. There's a lot of
investments on the
which shows a shift into earlier stage investment compared to late stage. So we can't say that there isn't capital because we've seen many fund announcements. And to Eden's point, which I don't disagree with, is in the GCC, specifically Saudi, UAE, even what we're seeing in Qatar, government sovereign support has helped VC fundraising, where there's a lack of LP funding globally. It's why everyone is coming to the region to raise funds. They are supporting the infrastructure with government initiatives, and therefore are they bucking the trend relative to everyone else, which is why he says it's not correlated to the interest rate. I'm not going to go into whether we agree or not unto that point, but there's different viewpoints. His is saying that there is still capital deployment as supported by the sovereign entities.
But by the way, sorry, on that point, on the interest rate, I think it does make a difference. I would tell you at my, like where I'm investing at the angel stage, right? Like when interest rates went up, a lot of angels said like, we don't want to invest in startups anymore.
Because of the crowding out effect that I mentioned.
And actually in 2023, we did 0 deals.
Yes.
Like there was no interest, even at the individual level.
And so then you can apply that at different levels now, but there are arguments to be made that it's not correlated by data. You can counteract that by what delays in investments here versus the US, where it's much quicker announcements and access to regulatory data. So the point in time of announcements that are made versus here, where there tends to be a lag sometimes in the reporting. That aside, the high level takeaway from this year is you are beginning to see the return of early stage investment. Why? Because your exit, which typically takes 7 to 8 years, means that if you invest now, which is why many people say your best vintages are in economic downturns, your payoff is in 7 to 8 years, where one hopes that the economy returns and we start seeing that bull cycle again. So your cost of capital and your ROI expectations, when valuations have either stabilized or come down compared to years gone by, and there are founders that have to be much more frugal in terms of mindset because they have to make their money work as it takes longer to fundraise, means that early stage has become more attractive relative to late stage. And it goes back to the simple math of you can have 50, 100, $5 million investments, which is extremely healthy for the underlying ecosystem, but your top level number will not reach the numbers that we saw dating back 2 to 3 years, where we saw the Kitopis and the Tamaras and the Tabis and the Uniphonics raising $100 million investment rounds. When that starts coming back, which is why I'm more bullish about 2025 as interest rates come down, as we talk about soft landing in the US, as we're seeing appetite for venture capital return, that we will begin to see more later stage investments, and that we begin to see, as we have predicted based on the data that's coming from the US, I expect that total venture investment in 2025 will be higher than 2024 for the MENA region. But I don't think that it'll be the hockey stick that we saw post the COVID era, and that will go back to gradual growth of venture investment in the region. But we've been through an anomaly of an experience that we are still seeing the consequences of heading into this year.
So let's break it down a bit. Let's start with the mega deals, right? So you said we didn't have many.
Yes.
In 2024, right? In comparison to the years before. But you said you're bullish about 2025. It's not going to be
more bullish.
Yes. You said it's not going to be a hockey stick, but
correct.
we're going to see potentially more. Where's that money, you think? Where's that 100 million check going to come from?
I still think the point that Ian makes is that the sovereign entities are playing their roles. I mean, we have already seen whether it's in Saudi Arabia, albeit there's a lot of talk of like cutting budgets and liquidity.
But those big checks aren't written by I mean, like I think I saw, I'm seeing some announcements by, like, let's say SVC, for example. I think they recently announced that they're leading a $150 million investment in global ventures.
Correct. So the funders have been deploying. So the funders are the funders, the LPs, have been investing.
So the fund of funds are investing in VCs.
But we've also seen the two phenomena. So just to break it down.
But also a $150 million fund or whatever is not going to be able to write $100 million check.
We've started seeing, as Sky was saying, you've started seeing General Atlantic come to the region.
Exactly.
In fact, in our report, you'll find that General Atlantic was the highest deployed capital of any investor in the emerging markets that we cover. Why? And that goes back to the point. Everyone's been coming to FII and to the region, to the different events to raise funds. They are now allocating part of their investment thesis to the region. Historically, if you remember the boom of 21 and 22, you saw SoftBank, you saw NEA, you saw General Atlantic, you saw Tiger Global, that were cross-asset allocators investing in your late-stage investments. So it's correct to say that it's not necessarily the local investors who are investing. It's part of the challenge, is that who are the local investors that are investing at late stage? Now, in Saudi Arabia, you have seen the roles of STVs, Sanabel. You've seen some of the corporates begin to play a bigger role at late stage. EAND here in the UAE has been both EAND Capital as the venture fund and EAND off balance sheet has been playing a role in investing at later stage investments. But the truth is that it is also international players that have been deploying capital at that late stage who have been supported by the sovereign entities. So they'll fill their investment fund and a certain part of that allocation has to come to the region. And so to see that return will be coming from the investments that come from either regional players that are looking to invest at opportunities that are attractive for them and or the international entities that are now setting up.
Do you see them coming back? Do you see the sort of 2021, 22 international players coming back and investing here?
Well,
big
you're
checks?
already hearing many of them setting up, whether it's in Saudi Arabia or here in the UAE and even in Qatar. And there's the other point. One of the things that I love about what we're looking at in the data is I've been very high, and we talked about it last year on the Southeast Asia and MENA corridor. You're seeing Southeast Asian investors coming and setting up here to have regional offices to invest. So it's not just US and Europe. You're seeing other venture roles playing a bigger part. Shane from Shuruk just wrote an article on my way here talking about the role that private equity has to play as an investor at late stage. One of the arguments, which I don't necessarily disagree with, is in the pursuit of more IPOs in the region. And that's a whole conversation in itself, the obsession with IPOs, which I think is a little bit flawed, but I can understand the sentiment. But the reason that people are so obsessed is that they want the liquidity. And part of the reason that they're struggling for the exits is because there's no late stage funding. Is there a bigger role for private equity to play in getting companies that are at that sky level of 500 million of investment, 300 million investment, $100 million of revenue that cannot go to traditional VC, are not yet ready to IPO, need a round in the middle, and that there's an industry of investors that is private capital that needs to support them to get to that stage. And so is there a private equity? We know about the challenges that were created post-Abraj. The number of private equity players in the region are a handful. Having said that, there is more interest and there are more people investing off balance sheet and looking to set up private equity. I do believe that that is a massive opportunity here in the region because there are many companies that are ripe for disruption with that type of level of capital. And that is an area that needs to be focused on from a government perspective to try and stimulate the private equity market, which has been challenged for the years gone by. So that's an area of investment to then get to IPO to be able to see the exits and the returns. So I think that's part of the challenge in this environment as to why there's been a considerable drop-off. And again, I say all of this in the context of this is not just a regional phenomena. It's exactly the same thing that we've been seeing in Southeast Asia, which we track. And it is part of the reason of why we're seeing this drop-off in the US. I mean, if you look at global benchmarks, total mega deal funding has gone down in the last 2 to 3 years. It is slowly picking up as of this year. IPOs are a great indicator because effectively our mega deal investments are the global IPO investments. There have been a lack of IPO listings in the US, especially successful IPO listings. Once we see the return of IPO listings in the US, you can anticipate that as a result, there'll be more mega deal investments here because they're correlated in terms of the investment behavior and the investment thesis, and then likely to see more IPOs happening here in the region as well.
So you're saying that the global funds are setting offices here, so there could be a return of the global funds here because they are the ones that have been traditionally writing these very big checks.
Correct.
And helping companies in those late stage rounds. But also you're saying that there could be an opportunity potentially for local funds or new funds that are private equity type funds to emerge that could provide exits to those venture capital investors that need to exit.
Correct.
Sky said, obviously, that the private equity industry was decimated post-Abraj. So actually, let's talk a bit about that on the venture capital side, which is, something we also touched on at the beginning of this, is that they also have to fundraise. Their business is to fundraise money and return money to their investors in 7, 8, 10 years, 12 years, maybe.
Yeah.
So they're in the business of that. But you said when you and I were exchanging WhatsApps before here, you said that the VC model is flawed.
Yeah. Well,
why do you say that?
I didn't say that it was flawed. I think that
you said the incentives, right? Like it actually. Let me contextualize this a little bit. I speak a lot to Fadi Ghandour, and I've heard him speak a lot recently about the need for patient capital. He gave a great example of an investment he's made in a company called Cordoba, maybe 12 or 14 years ago. And the founder moved to the US from the region, and he thought this was going to be a write-off. And today, I think they just raised at close to $2 billion or something like that. So he's saying that if he were a fund, he would have had to exit.
Yes.
Like he would have had to get out of it.
So the challenge is not that, I did say it was flawed, but
no, but
it was more.
But it takes, the point is, Philip, it takes time.
It's incentives. So the challenge that you have is the incentives. So you're discussing with Sky on your podcast the power law concept. Basically, the total number of investments that you need to make to see a potential return. The idea that if you make 20 investments, that maybe only 3 of them actually become big payoffs. Some of them just basically return back their investment, and the majority of them are likely to fail.
Yeah.
And again, when you put yourself in the shoe of the VC, that is the model in which venture is built on.
Yeah.
Right? So they will look for and accept that a small percentage have to pay off a huge amount versus what you were discussing, which I think is part of the challenge. Now, that's the VC model. That's why they raise funds. And most importantly, that is the promise that they're providing to the LPs that have invested in their funds. They have not told them we're going to do patient capital for 20 years and give you a X% return because of everything that I just mentioned about the crowding out impact, because of those LPs. And let's remember, who are the LPs here? In the US, you have pension funds, you have massive family offices, you have corporate institutions that asset allocate a certain percentage of their fund structure, whether you're Harvard or whether you're a big corporate that has equity exposure, fixed income exposure, cash exposure, a certain element to give a sweetener to their return portfolio into this asset class. The majority of the LPs that are here in the region tend to be sovereign entities, DFIs, so international capital, whereas the IFC, the World Bank, which had been stimulants for venture capital, development funds. You have family offices that are now getting into venture as an asset class, but the sovereigns have been predominantly the stimulants of venture as an asset class here. And so if you speak to an investor that is venture, LPGP, that is the model in which they look for. So when you discuss, which is what I believe, and I talk about this from an ecosystem building perspective or from a government building perspective, the concept of the unicorn is flawed for the ecosystem development, because what you would like to have is more success to breed further success. I.e., if a company sells for 50 million, the founder makes a return, the investor makes a relatively not very good return, but the employees see a return, then you have the second-time founder that can come and build a company that could potentially become a unicorn based on the... So from an ecosystem perspective, we would love to see, and I believe that we would like to start having more 50, 100, 200, $500 million exits, because the return on that investment is not the venture capital's incentive, which unfortunately from their calculations wasn't a good return on investment because they're looking for that unicorn number to pay off the fund. But from an ecosystem perspective, has returned for founders, employees, government for all of the work that they've put in trying to stimulate the economy. That's where I was saying that the incentives are important, and it depends who you're speaking to. A founder that's working for 7 to 8 years wants to have an exit. And for them, it's not that the payoff is the unicorn exit or not. They've worked all that time. They want to see something in terms of the rewards for their efforts. It may not be the same incentive for the VC. Now, you could speak to a VC and they will say, it is the fiduciary responsibility, as I've been told, of a founder to make sure...
Or a VC?
A VC says that it's the fiduciary responsibility of a founder to exit. And there's an argument there. They're giving you money. It is not a charity. They are expecting a return, which is why they put the pressure on the founder to think about the exit, to look for the second round of investment. It's why secondaries is now a huge subject of topic, because it can provide some liquidity to the investors. But the point that I'm making is it depends on who you're speaking to. And if you look at venture as an asset class here in MENA, we are now entering the 11th year, shall we call it, of venture capital investments. This is not decades and decades of growth. This is literally the second decade, if we date back to the first investments from, for the sake of argument, Fadi with WAMDA and MVI and Bico Capital and MEVP, that now each of which have multiple funds in the cases of BICO and MEVP. So natural evolution is that there's the evolution of the VC as well.
Yeah.
It's not single funds and emerging managers. There's multiple that have got a track record. And you were discussing this with Sky, talking about the difference between an emerging manager and a more traditional manager. So the concept that I was saying is that the incentive of the VC versus a corporate or a private equity or an angel investor that have very different incentives is one, to get the payoff from, and they're happy to understand that some of those companies might fail.
Yeah.
They're comfortable with the concept that some of them may just pay off, but their obsession or their return will come from the ones that have the considerable payoff. Whereas what I'm thinking is that the more success that we get from exits, and we have the stats at MAGNiTT, less than 6.5% of all companies that receive funding in the last 10 years, I think that stat is from, have actually had an M&A exit. And this is something I've become a lot more, I would go out and say that they haven't seen exits. Then I start getting criticism that, oh, but you've seen secondary exits. And there's a whole question about how do you track secondaries, because that's even harder to disclose than investment. So there are
So secondaries is basically the founder selling...
not just the founders. Could
or
be
the
founder
VC
or the
exiting
VC.
their position to someone else, etc.
Correct. So there may be some liquidity that isn't captured in pure M&A activity or IPOs, which is now why everyone is looking at how do you get IPOs, because that provides liquidity to all of the investors. So there is some liquidity that gets passed on at different rounds. But yes, it's a challenge of what is the ROI. For the investor, you can understand commercially, it's for that big payoff. For the market, you want to see more success because success breeds success.
Oh my God, I have so many comments on this. Look, I think what Sky said is very interesting, which is basically, you want sort of like the $50 to $300 million exit, which is super healthy, right? I mean, you don't necessarily want a lot of failures because we don't have that big of an ecosystem anyway. It's not like
you're going to have, statistically, you're going to have a lot But you want more successes.
But you have a lot of failures when you are aiming for that unicorn, right? Which means you're taking on a lot of risk. And you're potentially putting more money into the company when the company is not ready, et cetera, right? So, which is not necessarily great. I had this same conversation, by the way, with another founder who had like between, let's say, a $50 to $100 million exit, who was here on the podcast, the founders of Karzati. And he said, we did not want $1 billion company. Because that meant that we as founders had to take on a lot of risk, and we didn't want that. He said from the get-go, we wanted a $200 million company. But to your point, no VC wanted to fund them.
Well, so
they had to go get money from like 100%. Family offices.
But this is the conversation that isn't necessarily had. I go back to what we were talking about. Venture is not a charity. It is a return of investment to LPs.
Yes.
And there are certain businesses that are VC-style investments.
Yeah.
And there are others. Some coin it lifestyle. I hate that word because nobody's doing this as a lifestyle business. Some are solid businesses.
Chris called it that.
Fine. And people like to coin it because it's not a venture investment. Venture is hyperscale at all costs. That was the model gone past. Now we're talking about unit economics again and having to get to frugal founders that can make money work. The model, it was scale at all costs and to get as big as possible to be able to list with super high metrics of growth and revenue without looking at the bottom line. That is venture.
But can you scale that much here? This is the question.
So these are all the questions.
So maybe the right model here is private equity.
I was told by a VC in Southeast Asia.
What do you think?
When I went to Southeast Asia, well, I mean, look, I'm in a very different business in data. Data is a very long tail business. And I came to acknowledge that data is a very different business and it is not a venture-backed business, right? I've only ever done one investment round. And right now we're looking at different type of people.
Actually, no VC would fund you today.
As a business, it's a very different business. But it's a huge, valuable business.
There you go. That's
correct.
Exactly what I'm saying.
But I acknowledge that, right? So I'm taking acknowledgement that it is not a venture-backed business. Yeah. But that's what I think is the problem with the founder side. Mm-hmm. Everyone thinks that their business is a venture-backed business. Yeah. But the reality is that there are certain type of businesses that have the right type of structure. We talk about team, all of those things, great. But at its core, is it a venture? Is it a scalable business that is attractive for venture capital investments? If it's not, we go back to doing your homework. Why would they invest in you? And again, venture capitalists here in the region have become a lot more seasoned. They know the type of businesses.
Yeah.
A big problem from the region is exits, but we talk about sectors. Everyone is talking about fintech, number one in everything, right? We had the e-commerce boom. We had the fintech boom. We have the logistics boom. People come and say, why aren't we seeing more investment in sustainability?
Deep
Why
tech.
aren't we having deep tech? Why aren't we seeing more in ed tech? Why aren't we seeing... Where are the exits coming from? Ultimately, a VC wants to see the exit. Why is everyone obsessing about IPOs? Because we have not seen enough of them because they provide liquidity. So the question becomes, going just back to the basics, is VCs will invest certain type of companies, and you need to acknowledge that. So where the frustration is, they don't want to invest in my company. If you're a company that is not a venture capital type of company to invest in, the frustration is not that why don't they want to invest in me, is are you the right type of company? Now, if you believe you are the right type of company, then you have every other metric that you need to achieve to receive venture investments in terms of the right type of people, product market fit, the scalability. So we go to that scalability question, and the crudeness of a leading venture capitalist that I met in Singapore when I went to do our expansion in the region said, if you are not operating, and the crude truth of what he said, if you are not operating in the US, China, or India, to get to scale, then you shouldn't be looking to get venture capital investment. That was what he said. Agree with that, disagree with that as you wish. That was the hard statement of fact, that if you want to get to the venture unicorn status, you should be operating in the US, China, single market, huge scalable demographics with all of the challenges that presents. But those are markets. Now, as the market evolves, I believe that there continues to be opportunities, which is why I keep saying the corridor between Southeast Asia and the Middle East, because there are similarities in the challenges as well as the opportunities. But the crude fact is, to get to that scale, you have to have massive markets to be able to get into, albeit Saudi to a certain extent is defying the odds with the potential and the revenue per person that can be generated for certain types of businesses. So I'm not saying what he said is necessarily correct, but again, put yourself in the shoes of the investor and why they have these certain metrics to get to for scale.
So a couple of points. So on the Saudi thing, by the way, I also had GV Ravi Shankar on the podcast. He's one of the managing partners at Peak 15, which is previously Sequoia India. He said, what would be interesting is to see the multiple billion-dollar companies in Saudi, right? Not the kind of like the single-digit billion, like the double-digit billion, right? And he believes actually fintech is one of those areas that this could be possible. And again, probably so for all the founders out there that complain that yes, my company is not getting funded and there's no innovation in the Middle East and copy paste and all of that type of stuff.
Paste. Every company that has been successful to the 50, 300, 500, 1 billion have been copy paste.
Yeah.
Now they have tailored it. They have created concepts that are extremely useful.
So there's no shame in that, basically, you're saying.
I don't understand why there is. I'm a copy-paste business. I mean, what are we doing? We're tracking private capital in emerging markets, but doing it with a nuance of having a much more localized, verified data, qualified data, making sure that we're comprehensive in our data. But the reality is that we are capturing data similar to international players that capture data in the US and Europe, but making sure that we're more accurate, more relevant, more localized. There's no shame in doing that. If you believe you are creating an opportunity in a market where doesn't exist. I mean, you talk about what is a startup? Startup, it's being used a lot in kind of nomenclature.
Yeah, not every company is a startup.
You create an efficiency where inefficiency exists using technology that is potentially investable for venture capital. So backward engineer the process of venture. You're looking for a product market fit with a tech company to achieve scale and a team in a market that is relatively untapped. And so effectively you create an efficiency where an inefficiency exists using technology that can be scalable, that is likely to receive venture capital investment.
Yeah.
At its core, that's what it is, right? And so for that, you need to backward engineer the logic as to why you should be receiving investment.
So the VC fund, how does it make money? A VC fund manager, a GP, how do they make money? They make money on fees.
Correct. Well, that's just recurring fees.
On the
to get them
total
going.
funds raised, right? They charge 2% per year for like the period, for the first 5 years, and then probably like a smaller percentage. And then they take the carry, right? So every time they sell a company, they take a percentage of the profit. So it is their incentive to raise bigger funds, more funds, make more. Actually, one of the...
That is the industry. I mean,
I was speaking to one of the fund of funds here, and he was saying, he was basically not complaining, but he was pointing to the fact that fund managers are deploying so quickly, and then they're out again to raise their second fund or their third fund, right? Because it's a business. So the incentives, going back to the incentives.
But that is the business.
But that is the business.
The model, right?
Yeah,
like you just have to accept the structure it is.
But then that's why maybe they're more interested in this, high number of failures for a potential of, 5-6 companies.
Yes.
Hitting $1 billion.
But you have to accept that.
But is that the best thing for this ecosystem?
I don't know, but that is the market, that is the industry, and that is the business. And there is an element of patient capital and the need for patient capital, patience in general. I mean, we will not be able to be the US or Europe overnight. I mean, these take generational shifts. The origins of Silicon Valley and all of the investment that is done. And we're not even talking about here. I mean, we brought out a report, which I really liked in Q3 of last year, where we looked at the macroeconomic impacts of different markets, talking about GDP per capita, GDP, etc. The region still ranks relatively low, almost at 0.1 or 0.2% of GDP is in venture capital. Singapore has one of the highest at about 2.5%. The US is about 1.4%. So depending on what year you're looking at and etc. as a percentage of venture capital. You look at the US, we're talking about the 1940s and 50s, the origins of Silicon Valley, the evolution of hardware into software, many return of investment. And sorry, the point that I was making about kind of the fintech and the health tech points. If you see returns in that industry, you invest more in that industry. If you cannot see where the exit is going to come from, whether it be IPOing or even M&A, a VC will naturally not invest in that because they do not have the risk appetite or the returns to invest in that sector. Here or anywhere.
Yeah.
But it's one of the challenges. Why is everyone investing in fintech? To your point, you can see M&A opportunities. Those companies are scalable. They could potentially become IPO'd. So there is a light at the end of the tunnel.
Yeah.
If you invest, discussing the points that you were saying with Sky, not to pick on him, but I was just listening to the podcast yesterday while I was running. It's a very hardware, infrastructure intensive. Where's the exit coming from? Is that going to come from an IPO, etc.?
Talk about Pure Harvest.
Pure Harvest as a concept. Yeah. I'm just saying, like in industries that are not very clear path to exit, where you've seen either M&A has predominantly, look at all the data. We're beginning to see more IPOs here in the region. But historically, it's M&A which has been the generator of exits.
So M&A is another company basically buying it.
By mergers and acquisitions, whether it be corporates, big tech, international players that are looking to get market entry. They have been the traditional sources of exits. IPOs are a great source of exits, and that's a conversation that's worth happening. But historically, except the secondaries that we've mentioned already, M&As are the source of those exits. If particular sectors do not see that light at the end of the tunnel, you cannot blame the investor for not wanting to invest in that sector because it is not clear to them where their exit is going to come from. And we go back to, well, if they're going to be stuck in that company for 10, 12, 14 years, unless you are a Fadi that can understand and believe, I'm ready to wait 15 years because it'll be at a much higher valuation, but I believe in that company. But that is a particular mindset, and someone who has been as successful as he has been, not someone that may be a first-time manager that needs to prove a track record and show that he's going to make a return in 5 to 6 years so that he can justify raising another round and that they're going to be successful. So it's literally the industry. And that's the bit that you need to have open conversations with the incentives for. I heard you talking about the lady that said that she wouldn't want to invest if she can't. Well, There's a reason. Understand why she's saying that. And then Sky made his comment. But like, understand why she's saying that. But then understand why Sky would make a comment. But I think it's healthy to have 50, 100, 250, 500 million. It's a matter of incentives and understanding the logic of who's saying what as to why that return is important. I believe that I can understand both. I can understand the investor mindset because they have to report to their LPs. They have to report for their funds. I can also understand from an ecosystem perspective, if not a founder, that a $50, $100, $200 million exit for companies that have not necessarily raised huge amounts of cash, but proven good businesses. But where are those exits going to come from?
You've been tracking this ecosystem for a long time now. What do you think remains one of the biggest challenges here?
I don't think that the challenges have changed. I think that they remain the same since I started. I mean, the amount of government boards and committees that I join and conversations. You mentioned scalability. We've talked about, I'm not going to repeat it, why venture as an asset class requires scale. But in a multi-geographical environment, scale is challenging. And why are people focusing now on the UAE and Saudi? Unfortunately, without going into politics and macroeconomics, where we talked about in the era of Kareem's heyday, that they were one of the biggest scalable startups across MENA, operating in Egypt, the Levant, Jordan, Africa, Pakistan, and etc. Now, it may not make sense to do that. So you're limited by specific geographies that you can scale into, which is why many entities are looking further afield. Can Turkey be an opportunity for scale? Can Southeast Asia, Indonesia, Singapore be an opportunity for scale? And I do believe that even beyond the need for scale, entering new markets remains a massive challenge. The second is talent. You continue to compete for the quality of the talent. Now, not to say that there isn't quality talent. There is a lot of talent in the region across the whole of the geographies. But your competition is corporates, governments, other startups, international startups that are coming into the region. So the amount of talent availability that understand the mindset of what it takes to build scalable companies is not particularly deep for access. There's a lot of talent, but you're competing with all of those different players to be able to attract them to your company at a price point that makes sense. Funding, you can get funding. I mean, everyone talks about funding in the region. You can get funding if you are attractive and meet all of the criteria for what a VC. Now, more challenging at late stage than early stage. I've already said that 50% of all investments are between 1 to 5 million. So there is a focus on early stage. You're seeing more accelerator programs now than you have before. That's a point that people have also forgotten. COVID stopped accelerator programs because the whole value of an accelerator program was effectively bringing cohorts together for 3-4 months. Everything went virtual online. You are now seeing the return of those programs, which I think is extremely healthy at early stage. Funding can remain a challenge, but I think that that's one that will continue to kind of develop in the years gone by. And then regulatory environments for people to flourish. I mean, we talk about challenges of procurement and you look at challenges of banking setups. You're now seeing more banks than ever before support in that space, but it can still be challenging to open bank accounts. It can still be challenging to do international bank transfers. It can still be challenging to open up accounts for employees. So these are the same challenges I probably said 5 years ago, 7 years ago, 3 years ago. I don't think that those challenges have necessarily changed. The only thing is that you are also seeing competition that comes from government, which we've mentioned, I think Sky mentioned on the previous podcast, and more international interest than we've ever seen before. So international players are attracted to the region.
It's not a challenge, though. I mean,
it's not, but it could be a challenge for local players, but it's also an opportunity for them as well.
So like an A16Z, in conjunction with the PIF doing a $40 billion...
That's for VCs. I'm talking for founders. So for like the companies, you're seeing more international companies coming and setting up in the region and playing in that space, which is healthy as well. Competition is always healthy. It continues to develop product. But across all of the different sets, the attractiveness of specifically the GCC is one that you are seeing the attractiveness programs driven by government to bring Revolut to the region, to bring international players.
That's a challenge, though, right? I mean, if you are a local founder building your fintech here, and all of a sudden Revolut is here,
100%.
And actually, that's part of the mandates of these governments, is to bring talent here, right? So it is challenging for local founders.
100%.
So Philip, if you were a founder today listening to this, realistically, right, that like, I mean, I know there's a lot of hype and talks and all of this, but realistically, you'd want to be in specific industries, right? You wouldn't want to be, I don't know, in aerospace or something like.
Look, I mean, it's not that you shouldn't be in any of those industries, but again, your expectations of what you should be looking for are different. Fintech and financial services globally, regionally, is ripe for disruption. I mean, the question becomes, it's the MAGNiTT theory. It's like, what is it that you need to disrupt? And what is the largest scalable market for you to provide efficiency where inefficiency exists? Finance, and I come from a finance background, studied in finance, did consulting in finance, worked in banking, is a disruptable industry, which is why it has so much venture capital investment.
But so is EdTech, but obviously I think it's maybe more regulated.
It is, but it's more regulated. It's more localized. There's much more challenges. It's human being interaction. It's an educational. There's information that's shared. Finance in its purest. And again, when we talk about fintech, I mean, in its simplest, and I'm very much simplifying it, you're talking about remittance payments. I always love the idea that when you look at the industries that get disrupted, the first one that gets disrupted is logistics. Pick up, drop off, pick up, drop off. And e-commerce, for all of the boom of e-commerce, and not to belittle the choice, still the biggest solution is to get it delivered home. So it's the logistical side of the e-commerce. Logistics, which has become a massive industry of disruption and has been broken down by vertical, is product, people, goods and services, but it's the delivery side of things. My point being, in fintech, while there is a lot about different type of banking and buy now, pay later, etc., it's still money transfer.
Yeah.
Because you interact with money. Some of the biggest companies, that Visa and MasterCard, the amount of data and information that Visa and MasterCard have on transactions, because we're now all cashless and everything is payment gateways, is huge, because you have to interact every single day. And so one of the things that, again, it takes a serial entrepreneur to think about that.
Yeah.
You really need to think about what are the biggest things. I love on the few times that I get to go on holiday abroad or something like that, you realize when you're in a remote city, either on an island or in a mountain in a foreign country, you walk around and you go, what exists there that exists in Dubai? There's a shop, there's a pharmacy, there's got to be a school, there's got to be heating. You start thinking about what are the basic concepts. And then the question becomes, is there an inefficiency there? And can it be disrupted with tech? Otherwise, it's an offline business, which is a great business to run. And actually, one area that I think will become an emerging, not venture, but search funds. I'm hearing more and more people who have either successfully exited or stopped their companies look at what are traditional businesses here, which are generational businesses that may have had family-run, old-school mentality, not to criticize that could be worth revolutionizing with the use of some technology, not to build a tech business, but to use tech to modernize existing businesses, whether they're in construction, whether they're in retail, there's an opportunity of that, building those type of businesses as a search fund where you go out and find that type of company on behalf of an investor that is just traditional. Traditional businesses always remain an opportunity for growth.
Let's talk briefly on about the exits.
Yeah.
Okay, so we had obviously Talabat recently doing an IPO, very successful IPO, but then the share price is down. It's been a month. I've looked at like some other IPOs that have happened in the region. Like we've had Fowry in 2019. They IPO'd at $1 billion. Today, it's around 560 million or so. And Rami, obviously, 2022, SPAC at 300 million. Now it's 54. Swivel, 1 billion. Now 68.
The thing about the exits, look, we've reported this, and I've got it wrong, and I've said this on record. For the last 2 years, I thought it'd be a record year of exits, and they've continued to decline. Specifically, what we track, which is the M&A. So let's break it down. What are exits? You have M&As, which are mergers and acquisitions, which is a larger company coming in to acquire, not necessarily larger, another entity that comes in to acquire the stake, if not the whole of the company. You have these acqui-hires where maybe the value is just to hire the people, not necessarily the intrinsic value of the company, or you put a premium on the value of the company for it to be acquired in a merger and acquisition. That is what we are able to track to a level of confidence, because there's usually public announcement or information that is shared in those type of acquisitions. A recent phenomena that has developed in the market, Key Capital are doing this, and there's many different international players that focus on secondaries, are secondary investments, either as part of an investment, i.e. you do a Series B or Series C investment round of 50 and 100 million, and the investor that comes in doesn't like, and this is a rabbit hole conversation, but the cap table where there are many investors and therefore want to clean up the cap table and acquire the investment stakes of the early stage investors and or some of the founders. That is considered as a secondary exit. It's not full capital injection in the company. It is to acquire the already existing stakes at a premium. The secondary funds that I alluded to as Key Capital is that's what they look to do. They invest to take out secondary stakes. That is still a partial exit. The challenge we have and global companies have, it is very hard to get that data. People do not like to disclose their secondary exit. People generally don't have to disclose because it's a private acquisition. It's not a regulatory acquisition, albeit at the holding company change of registration. So in the Singapore, for instance, which has a public registrar of all transactions, you can find out secondary. Here in the region, people don't talk about it. And one of the challenges we have at MAGNiTT is sometimes you see these big investment rounds. You can hear a 50 million investment round for a Series A investment. We know that a typical Series A investment is, for the sake of argument, 15 million. Let's say it's inflated. Say it's 15 million investment round and it's a 35 million Series A. Well, part of that could be secondary transactions, but they don't disclose the level of secondaries versus fresh capital. So when MAGNiTT reports its annual report, it's to track fresh capital injection, not secondaries. So those are two types of exits. So when we report our M&A exit figure, it does not include secondaries. The third, which is a growing chorus of interest, is around IPOs. Now, I have many views around the IPOs. Sometimes it's an obsession because many people want to see the exits. I can see the challenge of liquidity in the market and that the IPO opportunity is one that can provide liquidity for investors, for founders, for employees, because there are not many challenges. Lest we not forget employees that have ESOP. That is not necessarily taken into account in secondaries. The majority of those have to get a trigger event, which is a listing, which can provide liquidity to their employees. And therefore, I can understand the sentiment for the need for more exits in the region. I've been part of different types of conversations and working groups around this. The problem is, what is the problem you are solving for? Is it late stage investments, exits, or the need for a more vibrant public market? IPOs are a great indicator, and public markets in general, of a healthy economy because it provides opportunities for liquidity, investment, growth, public listings, the general sentiment of the economy. The problem is the last thing you want are the wrong type of companies to IPO because you are effectively taking private capital and putting it into the public domain, whereby a retail investor,
which is a single investor,
a person that buys shares in that company, puts their trust and responsibility in that company to perform with their capital. And that comes with a huge amount of regulatory challenges around that. And so I've had many conversations with founders and investors alike to try and understand the sentiment around that. Investors clearly want to see the return on their investments, and this is one opportunity and avenue for that liquidity. Founders, and I'll keep it anonymous, one gave me one of the best answers around this is that, look, we're running through a process of being IPO ready, which is a concept I've never heard of. So while people talk about, will we see 5 IPOs in the next year? Maybe. What I'm more convinced of is there are probably 30 to 40 companies that are running through a process to be IPO ready, which means administrative, legal, structure, financial, to see whether they would be in a position to IPO. And as part of that journey, they have to clean up their books, get in the audits, making sure that they have the right corporate governance, succession planning, which he implied also makes them more investable. Because if they run through that process and can show that they meet certain criteria, they are more likely to get a later stage investment round than if they didn't run through the process. But the ultimate goal, in their opinion, which I appreciated, was that they wanted the public to benefit. Why should it only be private capital and venture capitalists that can benefit in the success of their company? They wanted to provide the opportunity to the retail investor to join their journey. But before they can get to that position, they need to make sure that they're in the right type of situation to be able to do that. And so again, it's important to kind of run through the incentives and the structure and what are the requirements needed for a company to be in a position to list, to put yourself into the hands of a retail investor.
Yeah.
And that's why it's not just about, we want to see more IPOs in the region.
It's interesting.
There's a whole process and journey as to why a company, and maybe you need more offline businesses to IPO, not tech businesses, because there's more structure specifically around profitability, which is one of the biggest challenges, is like companies need to prove, specifically in our regional listings, unit economics that can justify
2 or 3 years of profitability. Yeah.
In the US, there's slightly laxer, and there's the argument around whether that should be the case. But remember that you are putting your money, your company in the hands of retail investors and the risks that are associated with it.
On the one hand, actually, Sky was saying that we should have an avenue for tech companies to IPO with lesser requirements, right? Like, i.e., the requirement of being a profitable company, and then, a retail investor, an individual who's buying that stock can make basically their own decision. But on the other hand, you're right. I mean, people, when they are buying stocks in a publicly listed company, they are putting their trust as well that in the the SEC equivalent. I don't know what it is here, but whoever it is that
each government
that regulates.
SAMA, you have the CMA in Saudi Arabia, you have here the IFC, ADGM, all of the different regulators.
Okay, so basically somebody is making sure that this information is correct and this company is legit, etc. So I think it's interesting because on the one hand, IPOs are a way for these venture capital-backed companies to get liquidity for their investors, but also get the public to own stocks in the companies that they love, right? But on the other hand as well, you have to protect the investor. There was a piece that was done
by the London Stock Exchange that basically did some roundtable discussions on this, where they created a level of transparency. And I think part of the problem is that there's a lot of people talking about IPOs. We need more IPOs, more. But I don't think that there's enough discourse on what does that mean publicly. I'm sure that they're happening in round tables and government conversations, but like publicly for people to understand, what does that mean? What does that mean on behalf of the founders, the company, the management team? What does that mean on behalf of the investors? What does that mean on behalf of the regulators? Because it's easy for us to say they need to change the regulation, they need more unprofitable companies. Okay, what are the pros and cons? What are the consequences of that? Why isn't that happening? Why should it happen? What needs to change with all the other requirements to allow for that to happen? So I'm not belittling the point, but it's a point. There's a whole nuance around what that means to be able to have a regulator feel comfortable that that's the case. In Saudi Arabia, you have the Nomu, you have the parallel market to the actual stock exchange where the regulatory requirements are less. Yeah. Even within the SPAC domain, which in itself was a learning lesson to create structures that allowed for these type of listings. But then the whole industry faced several challenges when liquidity dried up. So what were the learning lessons from that exercise? I think It was Eddie on your podcast that said if he knew everything that he knew at the end, whether he would have done it again. So those are learning lessons. So it's simple to say, yes, we need to change the requirements to see more IPO listings, and profitability is one of them. What are the consequences of that for the ultimate beneficiaries that will be investing in that company? And that's a conversation. Not to say that I have a silver spoon or a solution to it. I've now come to appreciate the need for it. I've understood the challenges of it. I understand that there's an opportunity for it, but it's not about setting an objective that we need to see 5 more IPOs in the region. You need 5 good companies.
You need maybe exits, not IPOs, not necessarily IPOs.
You need both, but you need good companies, whether they are companies that are offline businesses or tech businesses, or how do you differentiate around them? In fact, one thing, and this is something that I found that was quite interesting, there is not a lot of quality research around companies that are listing. There isn't information that is available around the quality. And then who writes the research is a question that's always quite interesting. The research tends to be written by potentially the bankers that are listing the entities. So what is the transparency of information around the companies that are being listing? So there's a whole ecosystem around IPOs and listings that is worth having in the public domain that isn't necessarily being understood, because the simplicity of it is that we would like to see more listings. I believe that there's an opportunity for more listings, but what is the discourse that needs to happen to see more listings in the region? In a market that, again, lest we not forget, has seen a slowdown of IPO listings in the US because they've become a hell of a lot more less attractive than years gone by. And so we're in an economic environment where people are not listing. So what does that mean for our part of the world?
Maybe the silver bullet is, the article that you sent me written by Shane, which is that sort of private equity layer that comes in the middle, buys this company, makes them profitable, helps them focus on profitability.
That's the question of what's the problem you're trying to solve.
But then that might stifle growth.
But what's the problem you're trying to solve? Are you trying to solve the problem of having more IPOs? Or are you trying to solve the problem that not enough companies that graduated to Series B are able to get more capital to run through a process to be IPO ready to then list? And so there's 2 different problems there. There's an exit problem, and then there's are they ready to exit problem that needs to be solved for, potentially from capital that isn't available from your traditional VCs.
And a PR problem, if you're a country, right?
Well,
I mean, if you want to attract global founders to come here to the region, we want to say we have a path to exit as well.
Correct.
So that's a PR issue.
Yeah. So exits is definitely an area. And that's why we go back to the whole conversation we had, the VCs incentive and versus the government incentive for healthy exits, and the founder and company incentive to get return on the investment and time and effort of what they've built as a company.
One last question on the UAE-Saudi. So obviously they're both courting founders. It's not a secret that they're both trying to build their own ecosystems with their own incentives, etc. It feels, though, that like from a strategy standpoint, it feels that Saudi is more focused on the more established startups, sort of come here, move your HQ, we'll give you more money, you can scale here, it's a big market, you need to scale here anyway, etc. And then we'll give you potentially a path to exit. Whereas in the UAE, it feels that there's a breadth of sort of startups in the seed and the beginning stages. Do you feel that? I mean, you talk a lot to governments. Is it like a strategy to do that? I mean, is it like the?
Look, I think it's healthy to be operating in both, and I do think that the rhetoric and the sentiment has begun to change. You have definitely seen, unfortunately, that the region has struggled from a venture perspective in general. So to the points that Eden makes, and in general, that if you look at MENA, the Middle East and North Africa, 18 different countries, the concentration of capital in the UAE and Saudi has meant that a lot of companies have actually moved to those 2 jurisdictions, whether it be macroeconomic environments, economic environments, political situation. And therefore, they have become central hubs for growth. I love the fact that we cover Southeast Asia. Southeast Asia gives us lots of benchmarks and learning lessons, which the US or Europe isn't necessarily similar. Singapore, which is a 5 million people population, is the hub of all venture capital investments for the reason that all the holding companies are not BVI and Cayman Island, they're all Singapore. But with a 5 million population, it is very unlikely that you get to scale in that country. And therefore, every founder looks to operate in Indonesia, Malaysia, Vietnam, Thailand. So when you think about MENA, a lot of companies that have historically set up in the UAE then need to look at where can we scale into. Beyond that, for growth, for all the reasons that we talk about, the importance of scalability. The reality is that they have to be operating in both jurisdictions. And that is the opportunity that presents itself. Now, governments will have their own incentives and their own goals and objectives of what they would like to achieve. They are attracting many of the similar investors, international players. I agree with you that to a certain extent, they attract many of the companies that are at later stage to go to Saudi Arabia. But I don't think that they're attracting them. They're looking to operate in both of those jurisdictions. It is lucrative for a company to be in Saudi Arabia, having been based in the UAE, because the side of the market is attractive. Many of the success stories that we have seen, whether it be Kerim or Souk, or operate in both jurisdictions. I think the challenge is to say, and I won't lie, part of the challenge is MAGNiTT, and I think I've said this on last year's podcast as well. We can only report the data based on a single geography. It's impossible for us, with all of the challenges that we have in data reporting, to be able to say, well, actually, the venture capital allocation for Saudi was the following, and the venture capital allocation for the UAE was the following, when in reality, they're all BVI and Cayman Islands anyway, which is where the capital goes to, and then they're funneled into the operating models. So we can only report it as the headquarter of the entity within that specific jurisdiction. But the reality is, many of these companies are operating in all of these jurisdictions, and that the attraction is to continue to develop vibrant startup ecosystems. So in the end, you should theoretically be operating in each. Even Qatar is developing their own type of ecosystem for companies. But I do think we get to, if you look at the evolution of the US, specialization by industry in specific, even cities or metropolises. I mean, when you see Silicon Valley in the US, which is the hub of all venture investment, but the fintech hub of New York, you look at the agri-tech in Austin, you look at the natural resources and sustainability that can come out of Texas, you can see different type of lifestyle businesses that will come out of Miami. If we have this conversation in 20 years, I have no doubt that you will start seeing specialization by industry. Yeah. But at the moment, all of the focus is to do everything because there isn't real specialization. But I think at this point, governments, and they're doing a phenomenal job of that, are attracting founders and investors of all types, talent included, while they continue to meet their objectives. The only red flag that I have, and this is one that, again, you learn from Southeast Asia, and it's one that does concern me to a certain extent, is that you don't want them to lose their interest in the sector. So
the sovereigns and government, everyone has incentives. But if you don't start seeing the numbers give you the returns, you could start saying that's not working. When in reality, we've spent 2 hours talking about the nuances of what's happening and what's not happening, which is extremely important, that there is a fertile and growing ecosystem. There's a lot of things that are happening. There are challenges and exits that need to be addressed. But if you only look at the headline numbers, and we didn't quite get to 20 unicorns, we didn't get to 30 unicorns, we didn't get to $1 billion of investments, you could start seeing a disincentive for the sector, despite all the benefits that the companies have provided in that space. And the learning lesson that we're starting to see from Southeast Asia, again, I'm no expert in Southeast Asia. I cover Southeast Asia. I speak to investors from Southeast Asia. If you think that the MENA region is about 10 years of maturity in terms of venture capital, Southeast Asia is roughly 15 to 17 years. So they already have a 6-7 year head start in terms of venture. Similar to the Middle East, Temasek, GIC, sovereign wealth funds in those geographies have funded many
funds, multi-funds within specific institutions for investments in Southeast Asia. We have literally seen 2 years of almost 50% decline in venture capital investment, and many of the VCs that are based out of Southeast Asia are coming here. Why? Because to a certain extent, and I'm not saying it's completely categoric, the sovereign wealth funds have said, we have not seen the exits and we have not seen the returns on the investments that we've done. So until we start seeing those returns, we will not continue to fund the funders because we need to put the allocation of resources elsewhere. You've also seen changes in different entities within those geographies of people. Every time you change people that work at a government institution and or a development fund or an economic board that's focused on venture capital, they come in with a new mandate and they want to understand what are the pain points and what are the things that we need to solve for, right? So there's always that continual incentive that needs to change, which means I always say that founders have 10 years incentives or 7 years incentives to exits. VCs have 6 to 7 years mandates. Governments might have 2 to 3 years in which they have a mandate to see results. And then corporates have KPIs that they need to hit by the end of the year. Those are completely different incentives for all parties that are trying to work together. That's part of the challenge. So when you look at what's happening in Southeast Asia, the last thing that we would like to see is that they start pulling back venture investments because the numbers in this current year don't reflect a positive story, whereas all the investment and hard work that's being put to work actually is creating an extremely fertile environment. And we go back to the cyclical. If you invest now, whether you are a VC, a founder, and or government, the payoff will come in 5 to 6 years, where one hopes that the macroeconomic activity picks up, investment picks up again, and the returns start happening. And that goes back to the patience that we talk about and the learning lessons of cyclical, whether it's macro.
If you're a fund investing in VC funds, your view should be way longer than 10 years anyway.
But everyone has a mandate and everyone has someone that they report to that they need to see returns. So it's a challenge of like the high level number doesn't necessarily tell the story. There is nuances to the story. And right now, there is a lot of positive things happening in the ecosystem. They just don't necessarily translate into the figure that we saw in 2021 and 2022.
So predictions.
Yeah.
What's going to happen this year?
So, I mean, we made 5 predictions at MAGNiTT, and you can check them out on the platform. But effectively, I think there's a couple of things. I alluded to it already. I think that this year, 2025, high level figure will be better than what we saw in 2024. The point being, I think we've pretty much plateaued at this point. I do believe that as interest rates continue to come down, albeit there's a whole conversation by how much, late stage will begin to pick up. I do think we'll see the return of some mega deal activities that will help that number. I think that we'll continue to see early stage investment, but I don't think that we'll see that hockey stick that we saw during the post-COVID era. But in a positive light, we'll see that return of investment activity that I predict is probably going to happen in the US, maybe not globally, but at least in the US this year. Last year was characterized in the public market and in the venture capital by the obsession with AI. I have already seen generally, whether it be government, private, corporate events, and strong inclination and interest in AI as a product effectively here in the region. We at MAGNiTT have started going through all of the database to start tagging AI, because I think it's a complicated concept. It's not as simple. You're either AI, nothing, and a whole spectrum of type of things in between. But from the data thus far, while there have been massive announcements of G42 investing in hardware, big investments in Saudi Arabia, there's almost a competition taking place in the hardware of AI chip and solar generation and cloud warehousing for the solution. Investment in the software solutions locally has been somewhat limited, but I do expect almost a doubling of investment in AI native and enabled solutions that are going to be coming from the region in line with what happened globally. I've alluded to it throughout the podcast. I think that the challenges and the opportunities that exist in Southeast Asia and the Middle East will be a continued strengthening of relations between the two, lest we not forget that the challenge of Southeast Asia also remains that China, which is on their doorstep, has been a bit of a difficulty, especially because you do not see the Americans coming in and acquiring Southeast Asian entities or Southeast Asian entities going and listing on the US markets because of the challenges that exist there. So naturally, they're developing new partners, and this Silk Road that exists is one where we will see more government delegation visits from here to there and vice versa. We already saw the Ministry of Communication, Information Technology in Saudi take people to Singapore, to Korea, Japan, vice versa. We've seen delegations of Southeast Asian, Singaporean and Indonesian entities coming here. I think that will further strengthen. We saw Golden Gate Ventures and a few other Monk Hill Capital beginning to set up and relocate in the region. So that's the opportunity both from an M&A investment and VC perspective. I think we will see more international entities. We already saw the likes of General Atlantic in the public domain. We've seen the likes of Ray Dalio. We've seen the likes of Brevin Howard, cross-asset allocators, hedge funds. I think we'll begin to see more VCs who have managed to raise funds from the region, set up regional offices in the region, and deploy capital. How much? Question mark, but they will begin to play a bigger role into the local ecosystem, which I believe will be extremely healthy. And finally, I do believe that we will start seeing more IPOs. I like the idea that there will be more companies going through an IPO ready process, and it's relatively simple to identify them. Those that have probably raised Series B plus in the last 3 to 4 years that will either look to raise that private equity or growth round, the pre-IPO round. So even in the private equity data capture, you have private equity investments, and then you have growth capital, which are private equity funds investing in VC late stage rounds to position themselves for a late stage investment. And I do think that we will see, specifically in Saudi, if not also here in the UAE after the Talabat IPO, more IPO listings in 2025, likely to happen in the second half. And I would anticipate about 4 to 5 of those happening in 2025.
What did you get wrong last year?
Oof, great question. Well, the exits I got wrong again. It was another year that we did not see exit growth. We predicted that I got right, that we see almost flat investment through this year. So I think we did an average of 230 million was invested every month, but it was the lowest, what do you call it? Between the highest and the lowest quarter was the lowest percentage difference than any previous quarter that we've tracked in the last 5 years. Other things that we got wrong. Great question. I can't remember.
Okay.
Oh, we did an article on it. So you can post the article. We looked back at what we got right and wrong last year, and we also did the 5 predictions.
How do you sit and do these predictions?
Consuming huge amount of data, information, and insights. I mean, I would be...
How much of it is data? How much of it is like your discussions with the different...
It's a great question. I mean, both. The data drives the results.
Because the data is historic, right? I mean, there's this thing about data is that...
So a lot of it's subjective conversation and insights. And I'm not going to lie. I love the Eli Habib quote is that you can see what's happening in the US and it's probably going to be delayed here 6 to 9 months later.
We have a crystal ball here.
So to a certain extent, some of the trends, I mean, I predicted that there will be flat investment. I mean, the reality is that everything in the US looked like flat investments from the data in the US last year.
Yeah.
They started to pick up this year. I anticipate that this year we'll start seeing a pickup in investment activity. I mean, it's not rocket science.
So there's like a lag.
There's a lag in that investment, but you need to track the data to be able to kind of look at that and see what's happening here locally. But I think it's a mix, and it's also anecdotal. You have to listen to people. I don't claim to do this in a black box and not listen to what other people, investors, founders are saying. And thankfully, as you get to year end, lots of people are trying to share that. Some of them are ones that I agree with. Some of them I don't necessarily agree with. Some of them are because I'm speaking to the different protagonists. But it's a mix and match between them.
I mean, the data industry seems to garner more interest now. There's been some interesting acquisitions lately.
Yeah.
What do you think of that? Where does that put MAGNiTT? What are you, 10 years in now into the business?
8.
8?
Yeah.
All right. Okay.
Look, I think that data as an industry has proven to continue to be extremely valuable. I mean, people talk about how data is the new oil. In the venture space, it's challenging. I mean, you can look at all of our competitors globally. They're not companies that tend to raise too much venture capital because it's a very different type of business. The one that's raised the most is Crunchbase, but they tried to become a LinkedIn for startups, but then pivoted very quickly. All the others have been very efficient in their usage. What it has shown is that not just venture, so MAGNiTT's going on this journey towards private capital. We've talked about private equity, private credit, infrastructure, real estate. The idea is to move in the direction of being able to capture all of those with what is our stated mandate of becoming the platform for private capital across emerging markets. And so when you look at that space, the acquisition that we saw of Preqin by BlackRock, which had suitors like Bloomberg and S&P, was at a valuation of $3.2 billion. The deal is still to kind of close and come to fruition. But it shows the value in the challenges of capturing underlying data. Why does MAGNiTT exist? I mean, there are global platforms. It is difficult to capture this data where there are no regulatory bodies by which we can get this data. And we take very seriously the verification and the quality of the data that we put in. A lot of people talk about AI, oh, it's going to disrupt the industry. Well, if you put garbage in, you're going to get garbage out. And the reality is a core part of the business is to make sure we have the most accurate, reliable, and comprehensive data in the markets that we're in. And the payoff is that that data is so difficult to get right, to get it into a schema that is of value, to cross-reference that data, that when there's an opportunity, the underlying data, as well as the service offering and the client base and everything around that, is what we continue to kind of focus on. But the industry, and it's not just Preqin's deal, Mubadala has invested in a recent company in the UK that's looking at private credit. There are several acquisitions that are taking place and investment in the data space, but the investors tend to be entities that understand the value of data or use the value of data. So they could be global platforms that are the Bloombergs and the likes of those. They can be entities that require data as part of their financial services. So BlackRock was a very interesting one. They have a platform called the Aladdin platform that does basically analysis for portfolio allocation for the public markets. So they'll take a institutional investor, a private investor, say, this is your market, this is your portfolio. We talk about the power law and the different allocations. It'll predict based on industry trends, global trends, the risks and the returns of your associated portfolio based on all of these data sets. What they acknowledged was they have all the public data that's available for the stock exchanges, the bond markets, and etc. But when it came to the private data allocation, they didn't. They were having to use third-party resources to be able to pull that in. Part of the acquisition of Preqin was to get one of the leaders in the private capital space to feed the machine that they can sell that service to other entities. So that's another way of doing it. Publishers are continuously looking for entities that are interested in quality data. So data as a service has huge intrinsic value, but beyond just pure venture capital, but into the other private capital spheres.
And also, going back to returns, right? Private equity traditionally does more higher returns than public equities.
Yes. So in the long term.
Yeah. So
yes.
it is an area worth having more data on.
But it's also where it's opaque, the opportunity exists.
Yeah, exactly.
It's just very difficult to get this data and
get
it accurate, and then to have it benchmarked, which is why it's a very challenging industry, but it's one that has huge rewards where you can get it right.
Cool. Well, I hope that presents an opportunity for you.
Thank you very much. Always looking for good opportunities.
Yeah, so we can have a podcast on that. You can give me your hindsight on
one day
on what happened. Philip, that was a very, very super informative discussion. I think it's very important to be realistic about what's happening, optimistic. I think we need to be optimistic. Otherwise, I don't think there would be a venture asset class anyway. I mean, you need entrepreneurs and founders taking those big, bold risks and people who are backing them. So I think we need that. But we also need to be realistic.
I think the biggest point of the data is if you take 10 years, as we said, of the first decade of MENA venture investment. And the pickup of investment activity happened between 2015 and 2016, 17. Started seeing that record year of investment. You take that an average company takes about 6.5 to 7 years to exit. That exit window has literally coincided with a venture slowdown and a venture market, a macroeconomic challenge. And so the returns of those investments have to be delayed another 2-3 years, which is why everyone's doing those bridge rounds and everyone's trying to be lean so that when things start picking up again, you start seeing those return on investments. And so we just go back to patience, continued investment in the market, understand the challenges, or the hard truth of what you already mentioned. Some companies may just need to shut down.
All right. We'll leave it at that then.
Thank you very much.
Thanks a lot.
Pleasure.
Philip.
Look forward to doing it again.
Thank you so much for tuning into this episode with my friend Philip Bahoshy. I hope you found it insightful and inspiring. As usual, don't forget to visit conversationswithlulu.com to check out all the other episodes. And make sure you're subscribed on YouTube, on Apple Podcasts, or Spotify, or wherever you're listening or watching this episode to get notified every time a new episode drops. As usual, don't forget to leave us a rating and a review. I read them all, and it really makes me happy, and it helps in getting the show discovered. And make sure you share this episode with family, friends, colleagues, and whoever can really benefit from this content. We're actively looking for sponsors in 2025 so we can grow our platform. So if you want to partner with us, you can write me at hello@conversationswithlulu.com. Let's see what 2025 has in store for us, and see you in 2 weeks.